Token contracts. Token contracts are the foundation of most cryptocurrencies you see today. A token contract is a piece of code on a blockchain that defines how a digital token is created, transferred, and managed. The most common standard is ERC-20 on Ethereum, while Binance Smart Chain uses BEP-20. These standards ensure that all tokens built with them behave in a consistent way, which makes them compatible with wallets, exchanges, and decentralized applications. Token contracts control essential functions, such as minting new tokens, burning tokens to reduce supply, and transferring tokens between users. They are the building blocks of fungible assets, tokens that are identical and interchangeable, like regular currency. NFT contracts. NFT contracts are designed for non-fungible tokens, digital assets that are unique rather than interchangeable. The ERC-721 standard on Ethereum defines how to create a token that represents one specific item, such as a piece of digital art, a collectible card, or a ticket. Each token has its own unique identifier, making it distinct from every other. ERC-1155 expands on this by allowing a single contract to manage both unique tokens and fungible tokens at the same time, which is useful for gaming where you might have one-of-a-kind swords alongside identical stacks of coins. These contracts handle ownership records, transfers, and metadata that describe what the token represents. Decentralized exchange contracts. Decentralized exchange contracts allow users to trade cryptocurrencies directly with each other without a central authority. Instead of depositing funds into a company-controlled wallet, users interact with a smart contract that automatically executes trades. Platforms like Uniswap and PancakeSwap rely on liquidity pools, where users deposit pairs of tokens into the contract. The contract then uses mathematical formulas, such as constant product equations, to determine the price of each trade. Because everything is automated, there is no need for an intermediary to hold custody of funds. The contract enforces the rules transparently, ensuring that both sides of a trade happen at the same time or not at all. Lending and borrowing contracts. Lending and borrowing contracts power decentralized finance platforms where users can earn interest or take out loans without banks. In protocols like Aave and Compound, users deposit their cryptocurrency into a smart contract, which acts as a liquidity pool. The contract then lends these assets to borrowers who must provide collateral, usually more than the loan amount, to ensure repayment. Interest rates are set algorithmically based on supply and demand. Everything runs automatically. Lenders receive interest payments, and if a borrower's collateral drops too low in value, the contract triggers liquidation to protect the pool. This system enables trustless lending, where all rules are enforced by code. Stablecoin contracts. Stablecoin contracts are smart contracts designed to maintain tokens at a fixed value, usually pegged to a currency like the United States dollar. Popular examples include USDT, USDC, and DAI. Some stablecoins are backed by reserves held by centralized companies, while others use decentralized mechanisms. For instance, DAI is generated by depositing collateral into a contract that issues tokens equal to the value of that collateral, with automatic liquidation if the collateral falls below safety thresholds. The key role of these contracts is stability, ensuring that one token consistently equals about $1. This reliability makes them critical for payments, savings, and trading in volatile crypto markets. DAO contracts. DAO contracts, or Decentralized Autonomous Organization contracts, enable groups of people to govern projects and funds collectively without centralized leadership. A DAO contract contains rules for proposing, voting, and executing decisions. Token holders usually receive voting power proportional to the number of governance tokens they own. For example, proposals might include changing fees, funding new projects, or upgrading protocol features. Once a vote passes, the contract automatically carries out the decision without human intervention. This ensures transparency and prevents tampering, since all votes and outcomes are recorded on the blockchain. DAO contracts are essentially the operating system of decentralized governance. Insurance and escrow contracts. Insurance and escrow contracts use blockchain automation to handle risk and trust. In insurance contracts, users pay premiums into a pooled smart contract. When a predefined event occurs, such as a flight delay or a protocol hack, the contract automatically pays out claims to eligible users based on the rules coded inside. Escrow contracts, on the other hand, act as a neutral third party in transactions. For example, if one user sells digital assets to another, the funds are locked in escrow until both sides meet the agreed conditions. Once verified, the contract releases payment or assets. These systems eliminate the need for intermediaries by enforcing agreements with code. Gaming and metaverse contracts. Gaming and metaverse contracts create digital economies where users can own, trade, and monetize assets inside virtual worlds. These contracts manage in-game currencies, character items, and virtual land ownership. For example, in play-to-earn games, smart contracts distribute tokens as rewards for completing tasks or battles. In metaverse platforms, land parcels are represented as NFTs stored in contracts, giving players permanent and verifiable ownership. Contracts also handle marketplaces where players buy and sell items peer-to-peer, ensuring that trades are transparent and secure. By linking digital assets directly to blockchain records, these contracts make virtual economies function like real ones, with true player ownership. I made an awesome video about every type of crypto wallet, so don't forget to watch it later, okay?